Underwriting makes or breaks your multifamily investment, but what is underwriting? What do you look at? What does it entail? Well, in this video, I'm going to be walking you through everything you need to know about underwriting multifamily deals. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about multifamily underwriting. And this is actually a major component of the Multifamily Conference coming up May 14th and 15th in Toronto, live and in person. We actually have Pierre-Paul Turgeon, who worked at CMHC in their multifamily underwriting department, coming on stage to walk you through diving deep into multifamily underwriting. But today, I wanted to concentrate on three parts of underwriting. And the first part is actually the present. This is kind of like Charles Dickens' The Ghost of Underwriting Past and the Future and all that stuff. The first is the present day. So with the present, we are actually looking at the deal today at acquisition. You have the deal presented to you, you're looking at it. Well, what does the deal entail? What is it about the deal that makes sense to actually acquire it? So a couple of things we're going to look at, because underwriting is about the modeling. It's the assumptions you're making. It's how you're improving the property. It's everything combined. So it's your modeling component, it's your comparables, everything under that umbrella is underwriting. So we're going to look at a couple things. So current market comps. So for rental comps. With rental comps, we're going to be looking at comparable properties in the area. What rents are they achieving? Where is our subject property today? What is the gap or the delta? Where can we take that property with certain improvements? What do the comps have that we don't have, and vice versa? We want to have a good lay of the land in terms of rents, because we need to know what sort of potential upside we have in the rents, because this is going to affect our underwriting as we move forward into the future. And then we have to look at the current market, so comps for the sale price. So where are properties trading at? Is it $80,000 a door, $120,000 a door? What sort of revenue are those properties generating? What sort of cap rates are properties selling at, trading at these days? We have to look at that, because this is going to give us a good indicator of where we should be purchasing the property. What price are we going to go in at? Then we have to look at management. How well is the property being managed? What sort of upside do we have? Are there any efficiencies we can go in and take a look at? What's our business plan as it relates to improvements? I'm a big proponent of the value add system. What improvements can we do? And going into that is what sort of CapEx do we have to account for? Capital expenditure. This is the money we're putting into the property as we're doing the renovations. So as you can tell, we're looking at everything about the property today. So we're taking a look at the potential deal. We're analyzing everything we can to have a good understanding of where the property's at today, in this very moment at acquisition, so we can determine what purchase price we can go in at and how things are going to look. Now, once we understand the property today, we have to understand the property tomorrow. So the property tomorrow is during, we can also call this during the hold period. How is the property going to perform as we own it before we exit and sell? So let's say we're going to hold it for 5 to 7 years. What sort of rent improvements can we make? So what are rents going to do with renovations, with our business plan that we're putting into place, all the special things we're going to do to the property? How are rents going to perform? Then what are expenses going to do? Are they going to increase, decrease? Or can we optimize some things? Are we taking inflation into account? We have to model our rents and our expenses, our total revenue as well, because we may have, laundry income, we may have covered parking, other additional revenue streams with the property. We have to model these and forecast what these are going to look like over our entire hold period. If we're doing renos, we have to worry about vacancy. As we're renovating these units, how long are these units going to be offline? How many units are we going to renovate at a time? How is this going to impact cash flow and the revenue we have coming in? This is a huge component of it because if we're going to be working on the property for 2 years, we have to make sure we're not dipping under a certain threshold because at that point, we're going to have to be dumping more money in. So it's a fine line you have to walk. So once we've done the present tense, the property today, we have to forecast it over our hold period. So this is where the modeling comes in. How much rent can we bank on conservatively? What are expenses going to do? We're factoring inflation, renovations. What is our plan? How many units are we going to renovate? If we're using bridge debt, when are we going to roll into conventional debt? Because that's going to have a big impact on cash flow with our debt service. All of these things have to be built in to our tomorrow, our hold period underwriting. So we've held the property. Now we have to figure out what is it going to look like when we exit. We have the present tense tomorrow, and then let's just call this the exit. And I really should do like a Charles Dickens kind of thing with this. That would be kind of funny. So anyways, we have the exit. So what is the market going to look like when we exit? We always want to assume the market is going to be softer. It's going to be less favorable than when we purchased. So, if we're purchasing at a 4.5 cap today, well, in 5 to 7 years, we're probably going to want to forecast a softer market, so a higher cap rate, just to be on the safe side. We never want to assume that the market's going to be better than when we purchased, because if that does not happen, all of our numbers go out the window. And actually, that's a good point. On a spreadsheet, it's easy to forecast everything being rosy, but a spreadsheet is very different than real life and actually making things happen. So we always have to ground ourselves in reality and look at market trends, how markets performed. We could be exiting in a market downturn, things could not be so good. And in that case, do we have the right type of debt to wait out those kinds of situations? And maybe it makes sense to hold the property for an extra 1 or 2 years until things improve. But in that case, what impact does that have on our investors' return, their IRR, because their money's tied up for a couple years more? All of these things have to be taken into consideration. So our exit, what does the market look like? Are we forecasting a softer market? We have to look at that. And what's going to impact this? So how many more units are coming online, new construction units? Is that looking ahead for the next decade? Is there going to be lots of building? That's going to impact our exit. We have to look at market drivers. What is industry doing? What is the job situation going to look like in the future when we exit? All of these things we have to take into account and consider that. Now, nobody has a crystal ball, but we have to do our best to get the best data today so we can actually model. Because when we're doing underwriting and doing the whole underwriting exercise, if we put garbage numbers in, we're going to get garbage numbers out. But if we actually take time to try and get the best possible data that we can in our model, it's going to churn out much better solutions or much better answers for us that we can use. And then combined with the exit, this comes back full circle to our business plan. What sort of exits can we have? We want to have a couple options at our disposal. So maybe option one is to renovate 70% of the units and then sell to another value-add investor. But what if that does not happen? What if the market doesn't allow us to hit our targets? Well, are we able to renovate more and just hold it for a little bit longer? All these things you have to take into consideration. So when we're underwriting multifamily, just remember it encompasses everything. Everything goes into our model. So we have to worry about the property today. We have to worry about the property tomorrow, our hold period, and then what is the property going to look like? What's the situation going to look like when we exit? And all three things will have a huge impact on how you underwrite and model and analyze your multifamily deal. And like I said, we are covering all of this stuff at the Multifamily Conference, so go to multifamilyconference.ca and get your ticket now. And if you like this video, leave a comment, hit the like button. It really helps out the channel, and I do really appreciate it. And until next time, happy investing.